the people truly believe in their deals. Everyone believes in their deal when they're sending in the application. Like, yeah, I need the $500,000 to do this deal. But there's a mixture of reasons why the deal might not be good and they don't even know it, right? Like
Right.
the investors that are asking for the money are just doing their best diligence, but they don't know that it's good. Additionally, you don't like, they might have other issues that get in the way of the deal. And so there's a reason that other places are maybe rejecting them and then they might end up in your hands. And they're good at selling the deal. Like they're like hyping it up. Everything feels amazing. And then again, I think we ended up doing it and got to the lawyers looking in the back end and there was a bunch of other shit.
Yeah.
So it's like, okay, now I see why you're here. But if you're looking at getting into this game, like you want to be experienced, you probably want to work somewhere, take your time and underwrite the living lights out of it. And don't be afraid to say no. I would say no more than I'd say yes.
That's a great kind of way to leave it too, is that don't be afraid to say no. And I think that's the trouble that some get into early on, where they're so excited they get a deal coming in. Okay, what do you need? What do you need? Let's fund it. I'm not going to look at anything, right? So
thanks for tuning in to the Canadian Private Lenders Podcast, the show about starting a private lender in Canada, the mortgage industry, and the real estate industry. Your hosts are Neal Andrino and Ryan McNeil. Enjoy.
All right, everybody, welcome back. It's episode 40 of the Canadian Private Lenders Podcast with your hosts, Ryan and Neal. Neal, number 40. How's it going?
Wild. That's actually, damn, it's almost a year.
It's a number.
Which I guess kind of
a round number.
Yeah, that is a round number. I guess it kind of makes sense because we just broke a year on Keystone.
That's right.
So,
yeah, we started this shortly after. So,
yeah,
pretty cool. We're feels like some momentum developing, and we're feeling good. So, enjoying the feedback we're getting.
Big things planned for the year to come.
Yes, sir. Lots to come. So we'll have more on that. But what do we want to talk about today, Neal?
Private lending, like we always do.
Yeah, I like that.
This is like a little recap on the process. I think we did it very early on, probably like episode 1 or 2.
Yeah.
And then I think we've gained some new people listening, so kind of going over that whole process again.
Yeah, exactly. And I think we definitely went through this in an early episode, like you said, but I don't know if we went into the level of detail we want to go through today, kind of each step of the process of starting with, how you get a deal all the way to funding it.
Yeah.
But we'll go through that. Anything you want to talk about off the top, or
no? We got a little good one here, which I think we'll go right into the information side of things.
Yep.
Okay. Well, the one thing that just came across my mind as I'm sitting here and you said it, I feel like the name has to change for private lending. Like everyone thinks negatively of it.
That's funny that you say that. I listen to similar podcasts in the States, and they often call it hard money lending in the States. And
also doesn't sound super sexy.
No, it doesn't. and I've heard them say the same thing, that you should get away from the hard money name and move it to private lending. So, but what do you call it? I mean, you could call it alternative lending, but that it's so broad, right? And it encompasses so many different types of lenders that offer different products, versus private is truly that intended, short-term, real estate investor focused type lending.
Yeah, I agree.
What's your suggestion, Neal?
I don't know. I like alternative lending more. I know all my buddies that are in banking like to throw a little bit of shade and shoot shots at me.
Yeah, but they have their private banking side too. So what's the difference?
Yeah.
What's the difference?
I know.
They need to get over their stigma. Yeah. That's their problem, okay? They're not invited on the podcast.
No. So anyways, just a thought. If someone's got any name, shoot it in. I'd love to hear it. We'll start using that.
Yeah. For sure.
All right, let's make this deal happen.
Okay, here we go. So off the top, how do you get started from scratch in the private lending business, right? So of course, to get in the business, you need to have deals to do.
Yeah.
You need to have transactions you can finance, okay? So the first step really is to acquire those deals, whether that's through, a network of mortgage brokers, your own personal network, or, if you're already formally set up, maybe you have a submission platform that you're on. And, maybe that's like a mortgage automator or the mortgage office or something like that, where you can actually service deals through there. But really, where we're starting with here is you're likely in Canada, at least, you're going to be networking with mortgage brokers and or real estate investors to source those deals, right?
Yeah.
And you got to kind of know what you're looking for, right? You have to have a feeling for what level of risk are you going to take on? Where are you going to be focused geographically? Are you lending in Ontario? Are you lending in BC? Are you lending in Atlantic Canada or Nova Scotia only, right? What type of loan to value do you want to do?
This is interesting to me because it's funny. We actually had a listener call me maybe 3 or 4 days ago, and this was the first question he asked me because he had a little bit of capital sitting aside.
Yep.
And my honest recommendation was, and again, I think everyone needs to consider this, is we're saying this, I think, as if you're starting an actual private lending business.
Hmm.
If you're an individual, this is pretty difficult. You definitely would need to go through a mortgage broker, I would say, for the most part.
Yep.
Pretty infrequently would you want to be doing direct lending, and not to question anyone's like knowledge base, but I'd say it's pretty easy to be bamboozled by an investor, and they can create paperwork that like in any way you can be like, well, there's equity here, and this works, and this is what I'm
Yeah.
going to do.
A real estate investor, you mean, right?
Yeah, exactly. Whereas when you get a broker involved, I understand they take a percentage of the fee or whatever it may be, but they also have their reputation on the line.
Yep.
So any reputable mortgage broker is going to vet the deal and stand behind it a lot more than if you get someone. And there's usually a reason. If someone's coming to you directly, like as an individual to an individual,
Yeah.
that's a concerning sign in itself. Like, I feel like that's like red flag number one.
Yeah. The broker's also going to have the best interest at heart for the borrower.
Yeah.
And the lender as well, because there's
Yeah.
relationships on the line. So that's a good point. But to your point, it still does happen. Direct lending does happen, right? You're lending to a buddy of yours who is buying a sixplex, right? And maybe you're doing it on a handshake, which we highly recommend not doing. But and we'll get into that aspect of it as well. But to your point, this is more so for someone who's kind of formally setting up and doing more than a handful of, or planning to do more than a handful of deals.
Yeah, make this a part of their business.
So part 1A was to acquire the deals. What's part 1B, Neal?
All right, 1B is raise capital. There's an option. You can use your own capital. So again, if you have some people have a big facility, if it's from their operating business or they have a bunch of equity in real estate they already own. Additionally, and you do see this, like people will borrow from others, or maybe they pool it together, like a group of guys each have a couple $100,000. Like, we're all going to put it together, have $1 million, and we can kind of lend it out. And then, like I said, like a line of credit or some sort of facility. I've seen people do like margin lines on their investment portfolio too. Less common now because these lines of credit are touching on like the 8 to 10%, even 12% range.
Exactly.
But so the big thing with this and like is coinciding it with when you get the deal leads, because there's a mixture of, if you're taking money from somebody else, you typically you have to start paying on that capital immediately.
Yep.
Right? Because they're effectively lending you the money and then you have to lend it out. Right? So a line of credit's nice because you only have to pay once the money goes out. So pretty much once you start charging your person that you're lending it to, they can start paying basically your cost of capital.
Yep.
But if you are borrowing from others and they're investing in you, you need to figure out a way to be able to handle that. And that's maybe where a group setting works. But the best case, I'll say, with raising capital is if you can get to a point where people are committed. So they can be like, look, I will put up $500,000. Give me a call when you need it, sort of thing. That's your best case. The difficulty becomes these people, if they have $500,000 and they're willing to invest it in you, that means they're also willing to invest it in other things. And so they might say, yeah, I got $500,000 today. If you don't call them probably within 10 days to allocate those funds, there's a good chance that they're going to find a way to allocate it. And I've seen this so much. Anyone who has that kind of money sitting there is like, they'll even just go, I just bought a GIC.
Yeah. They're not going to sit on cash, especially in an inflationary environment, right? Where you're actually losing money by letting that sit there, do nothing.
Yeah, exactly. So, and there's a million opportunities out there, whether it's businesses and there's also a bunch of people that need money. So they might find someone else that needs the dough and just do a direct deal. Anyways, raising capital, it's good to do it. Like once you have a deal, obviously you really got to do it. If you can get to a position where you have it committed or available through some sort of credit facility, that's your best bet.
Yep. Yeah. And to your point, that's got to walk hand in hand with getting the deals coming in.
Yeah.
The raising capital piece.
Yeah.
Next step after you've acquired the deals and raised capital, you got to underwrite the deals. So
this is
how do you underwrite deals?
The road.
Right? Your first step is to find a great underwriter and pay them a bunch of money. But if that's not possible, maybe more realistically, you're going to underwrite your own deals.
Yeah.
Okay. So you got to really understand, what are your key business pillars? Like, what are you looking for in those deals? Are you looking for urban deals only? Do you only want to lend in Halifax and in Toronto and Calgary? Or are you okay going rural deals and maybe charging a little bit more and making more margin on those ones? Okay. And if you are, and beyond that, what sort of LTV do you want to do? Do you want to go up to 80% LTV and maybe earn yourself a higher return? Or are you going to cap out? Maybe you're looking for rural deals at 50% loan to value. And there's an opportunity there as well, right? Do you want to be first or second position?
Yeah.
And again, there's opportunities there where, first position, you've got great security, your first priority if anybody defaults.
Yep.
But second position, you can earn more.
Yep.
Right? So there's opportunity there. What sort of term are you going to offer? And what type of deal are you going to look at? Are you looking for, maybe just purchase and refi business? Or do you want to go outside the box a bit and do those fix and flips? Do you want to do some commercial deals? Do you want to do construction deals?
Yep.
All those things, you have to have that criteria in place and apply that to when you're underwriting the deals.
Yeah, I think that's just like going to hammer on that. It's so important that you already have kind of your criteria laid out and you follow them, because otherwise it's always going to be, first of all, it makes it a pain in the ass to do deals if you don't, because every single deal you have to like scrutinize the whole thing. But if someone comes in and you're just like, I want 95% and I'm in this location, and like, well, I don't do 95% and I don't do that location, it's dead.
Easy no.
Easy no. Takes
Move
you
along.
2 seconds, you move on. So there's that aspect for speed. And then the other thing is for your own consideration, because I know anyone who's a deal maker or putting money out, like, you always want to do the deal. So you need to have your own like stop orders, like in place, your own blocks that keep you from just doing bad deals.
Exactly.
And so it's good to like outline this now. This way, when it comes in and if a broker comes to a broker, or the investor or the person that's borrowing the money is pressuring you,
Yep.
You're like, no, like I have my rules that I follow. I'm not going to go against those. Or if you are really keen to get it out, maybe you're like, well, these are my rules. This is usually what I charge. Because I'm breaking a rule, I'm going to charge additional cost, because that's additional risk for me.
Yeah, great point. And I think not having that in place in the early stages is where you're going to get into trouble.
Mhm.
If you do your first 5 deals and you don't have strict underwriting criteria and 3 of them go sideways, you don't have a business anymore.
Yep.
Right? So that is critical. And if you're not comfortable with having your own underwriting criteria, you don't know how to apply it, probably best that you look to invest in a mortgage investment corporation or mutual fund trust or some other option like that, where they've got reputable management already running in and experience there, and you can still garner that nice return.
100%. Is there a third party underwriting? Is that a thing?
Yep, there is. There is. I don't know if I've seen it applied as much in the private lending business.
That's what I mean. Yeah.
But for example, I don't think it's any secret, but First National underwrites for TD Bank and for BMO.
Yeah.
In the broker side.
I guess, 100%. I knew on the larger scale they do. But is there like any sort of, I guess, I don't know if there'd be even that much demand for it. Like, people getting individual deals underwritten.
Because
every huge liability risk.
Yeah. On the alternative side, everybody's so unique in what they look for and their criteria.
It's almost their value prop.
Yeah, exactly. So I don't know if it would apply the same way with third party.
Interesting.
Yeah. What's next, Neal? Number 3?
Number 3, commit to the deal. That one kind of makes sense. But if you've done all your underwriting, you have the capital ready to roll, you got to commit to it. But easier said than done. With committing, you need to also have a term sheet that people are signing on to, that they agree with everything. Again, this is where it's really difficult if you're an individual trying to do one loan, because you're kind of making it up on the fly.
Yep.
Usually your lawyer's doing it. But it'd be best to have this done in advance for also speed and efficiency. And again, you don't want to have those conversations to like restructure it, right? Whereas again, if you have a standardized term sheet, when you do commit to that person and you say, yeah, we're ready to do it, boom, here's the term sheet. It's not like they're being like, okay, I'm going to put together a term sheet, because then they know when they get it, they're probably going to negotiate with you on some of the fees and any of the other issues. So part of that is we have on here, get a great real estate lawyer.
Yep.
Which makes total sense, but you want one that's experienced in doing this. I know, not to rag on anything, but there's, for us in Atlantic Canada, there's not a ton of volume of alternative lending. So you may have to look to alternative marketplaces where it's more relevant, and you can get lawyers that are very experienced and can help you create what you need.
Yep.
There are great lawyers in Atlantic as well, but just again, for ease, you typically go to the areas where it's more common.
Yeah, absolutely. Cool. So next up, number 4, collecting documentation. So as part of your commitment and your underwriting of the deal, there's likely going to be certain documents you want to see to confirm that information that borrower, the broker, is relaying to you, right?
Yep.
So something to consider. Are you going to be reviewing an appraisal, which we highly recommend you probably want to do?
Yeah.
Especially on a refinance deal that you're doing for your buddy down the road. If he tells you his house is worth $500,000 and the appraisal comes back at $350,000, you might have to adjust some things, right?
Yep.
Are you going to be reviewing tax documents? Are you going to be reviewing their income or their bank statements? What about mortgage statements? If you're in second position and they say they've got a first mortgage of $200,000 and the statement comes back and it says $300,000, or there's another line of credit in there in second position, you're going to know these things.
Yeah.
Right? And that goes back to having a great lawyer as well, because chances are they're going to check off on that. But you'd certainly want to do the first check and not waste everybody's time and money.
Man, I know people who've done direct deals and they don't take any documents because it's just they're like, yeah, like this sounds good and this house is worth this much, and then it ends up going to hell, and they're like,
Yeah.
the house isn't worth nearly as much, and like it's just because if you're not like again for me, I'm like, oh, especially in Halifax, a small markets, we all kind of know what things
Sure.
are worth, and then we're like everyone that I'm surrounded by is in the real estate game, so it's very easy to know we're like,
Yep.
oh, that's not worth this. But these were non-real estate people that had extra cash that wanted
Yeah.
to get a return, and they lent on homes, and it's insane to me that they didn't even get the basic appraisal or anything to prove that the valuations were there. But yeah, that one I think is a major item, and,
Yeah.
and you got to fact check that appraisal because there are like appraisers that will say anything.
We're gonna go down that road.
I'm
Yeah.
just they have a legitimate way of coming up with it. They're like, well, technically you can build this there,
Yeah.
and if you take off the construction cost, that leaves the land value at this. But it's like,
Yeah,
yeah, but no one's going to pay that land value. So is it actually worth that?
for sure. Speaking of which, let's do an episode on appraisals.
We should.
Maybe even get an appraiser come on.
I was just thinking that. I'm like,
Yeah.
who would come on that would be like, it's such a touchy,
It is.
it is a touchy thing.
It's
but
worth
we'll-
discussing. Though.
it-
It's,
oh,
it's a
100%.
critical aspect of the business.
Massive.
Yeah. Okay. So, and to your point, I mean, in some, if you're looking at Halifax, we're lucky to have a Viewpoint here in Halifax where you can,
Yeah, it's very easy.
or across Nova Scotia, but you can easily compare values there. So there is due diligence you can do on your own, but each individual property is different as well. Some are more dated, renovated, right? So you don't maybe have all that information at your fingertips, whereas an appraisal should show you a much higher level of detail.
The other thing I'm going to say, and something to be somewhat considerate of, and I probably could have said during the underwriting process, but even maybe in this collect documentation, don't be afraid to do a site visit, especially if you don't have a ton of volume out there. Like a lot of things can change from when that appraisal was done, and or depending on like how they took their pictures on the appraisal. Like there's a lot to it. So if I was doing only a few deals, I would be definitely like we do it now. And you go visit site because a lot of shit can change. Like you might lend on a house that's worth 500, but if it's gutted out now, it's only worth 250 or 300.
Absolutely. That's a great point. We try to do site inspections as much as possible. Not always available to us just because we're so geographically diverse with our business across 4 different provinces.
Yeah.
But, we know some lenders in GTA and they literally inspect every single home. And, the one lender I'm thinking of as well, they don't even do appraisals because they land in a specific area. They do all the site inspections themselves and charge for that. Yeah. And they've got comparable data readily available, right? So in that scenario, that's just as good, if not better, than doing an appraisal.
I was going to say, it's probably better. It's a bit burdensome, especially if you start to get the volume up there. But if you make it part of your business, like it's a really good way because, again, things can change.
Then you're ensuring, your own eyes are laid on it, right?
Yeah.
Yeah, absolutely. Number 5, Neal?
Instruct the lawyers. So now you've gotten to the process where everything's satisfied, everyone's happy. You probably or hopefully inspected the property. And now you actually need to get the thing across the line. So you're going to pass all of your documentation off to your amazing real estate lawyer that you now have. Their lawyer is going to double check and confirm everything has been met on that term sheet that you had gotten them to sign. They're going to double check to see if there's any tax arrears, mortgage charges that weren't disclosed, maybe like a line of credit, any outstanding liens or debts, whatever there is that could get in the way of you having full security and any title issues. And then they will also coordinate with your borrower's lawyer and come up with a closing date to actually get the funds to your borrower moving forward. You probably have that in your term sheet, kind of what you're targeting, and you probably already agreed on a date. But lawyers need to, at the end of the day, give the final sign off because they're going to be moving everything around. But again, very important part. And likely once you get to the stage, I feel like there's almost always something that comes up.
Always.
It literally never just goes there and like, yeah, no, all the check boxes are checked. We're good. Like there's always some little thing that's going to pop up in these situations.
Yep. Absolutely.
So it's really important that you have someone that's
critical
and a fast lawyer. Like I feel like so many people have like a lawyer like, my family's worked with them for 50 years. Blah, blah, blah. Like they are good. They're super knowledgeable. But typically with this stuff, you want maybe someone that's like interested in volume and being quick because there's going to be a lot of quick moving around. And typically timeline's really important with this money.
Absolutely. Speed is everything. We've talked about it 100 times on here, but you're right. If you're not a fast lawyer in this business, you're not going to last long on the private lending side support from a legal perspective. And that goes not only from a lender perspective, even from brokers as well, selecting who they want to use from a legal perspective because you got to get it. You got to get it moving along, and the client needs the money.
The thoughts on having the lawyer for the private lender to handle the borrower as well.
Well, you want to have that independent legal advice on any given transaction. So typically it's handed off to someone within the same firm
Yeah.
who's doing it. Well, that'll independently review the client's side of things. So I think it's important that there's that bit of separation there. But that does tend to significantly increase the speed when you're going down the hallway in your office to talk to another lawyer and saying, we're going to target this date. Can you get it done?
Yep.
Rather than going back and forth between two offices and delaying 7 to 10 days.
Yep.
Right?
Makes sense.
Yeah. And the last, but certainly not least, is funding the deal. So this is the exciting part, right? So once the lawyer finally does have all those conditions satisfied, they're going to instruct you to send the funds.
Mm-hmm.
You never, ever want to send funds directly to a client. That is not the way to operate in this business.
Yep.
Always go through a lawyer, a real estate lawyer. More secure that way, less risk of, cyber attacks or anything like that, banking issues, and just the fact that it's all documented and goes through that legal process. And then your lawyer will disperse to the borrower's lawyer, and then you're done. Congrats, you've got your first
You're a private lender.
You're a private lender. First mortgage is on the books.
That's all it takes.
Yep.
Questions
Nice
for
and
you.
easy. Yes.
What happens when you get to instructing lawyers and everything falls apart?
Well, nothing typically.
What about the costs incurred?
Yeah,
to that
the
point?
costs incurred. Typically, most lawyers are pretty good, and if it didn't reach a certain stage, they will just, they'll waive it in
Okay.
that scenario. If it gets to a point where you actually funded the deal, like you already sent the funds out, and then they've got to return it back.
Yeah.
The client, the borrower, is technically
On the hook.
For legal fees and potentially lender fees as well. We've historically been flexible with that. If there's legal fees incurred, sorry, but the borrower's incurring those legal fees. You chose to go ahead with it.
Yeah.
So it's they tend not to be too crazy, but we're not going to be able to eat that out of our margin on a deal that we didn't earn any money on.
Yeah.
But we've always said we're relatively we think we're fair in this business that if it doesn't actually close, if the funds didn't reach the borrower's lawyer, then we're probably not going to charge our fee.
Yeah. That makes sense.
Yeah.
Would you ever commit to a deal without having funds fully secured?
Ooh, that's a good question.
I'm just thinking. I'm thinking from the perspective of someone who's trying to do this.
Yeah, that's a really good question. Depends on how much. Do I need $1 million or do I need $50K?
I guess it's an idea of like, can I scrap this together if it really hit the fan?
Yeah. You want to have at least a backup.
Yeah.
Right? And maybe it's going to cost you more.
Yeah.
But you want to have that backup. A fail safe. Exactly. So I'll leave it with maybe on that one.
Do you think in that same process, maybe to someone starting, it'd be worthwhile being like having a relationship with another private that it's like, yeah, we'll scoop up the deal if you're unable to pull it off, sort of thing?
Not a bad option. And for some, it could even be investing in another private lender for a period of time, building your comfort up, and then making a little bit of extra cash, and then going out onto your own to do a couple deals.
Yeah.
Right.
Having gotten involved in this from not being in the business, like I would say to anyone, if you're going to do this, you have to have like worked at a private before, be a mortgage broker that's done a lot of private lending, like even coming from a financial institution. Like I think that's where a lot of them struggle maybe in becoming really successful sometimes, is taking people from regular FIs and moving them into the private space because it's so totally different.
Yeah.
It's like almost building a property manager or like a financial advisor at a bank, and then you're supposed to run your own private investment portfolio of properties. And it's like, yeah, you did 1,000,000 mortgages and were involved in a lot of people's stuff, but now like it's very different because you're running this book.
Yeah.
And so like, and I think that's where some people probably, they're like, shit, the risk level is so much higher. It all falls on me.
Right.
So I'm just, I like I said, I'm saying all this because I got a call from one of our listeners asking about getting into this. And like, it just makes me nervous because I'm like, the other tough part is the world's ripe to, like, there's 1,000,000 people that take that money. And not that they're looking for people to screw, but everyone's like, the people truly believe in their deals. Everyone believes in their deal when they're sending in the application. Like, yeah, I need the $500,000 or $100,000 to do this deal. But there's a mixture of reasons why the deal might not be good, and they don't even know it, right? Like the investors that are asking for the money are just doing their best diligence, but they don't know that it's good. Additionally, you don't like they might have other issues that get in the way of the deal. Um, and so there's a reason that other places are maybe rejecting them and then they might end up in your hands. And they're good at selling the deal. Like
Yeah.
again, I can't stress like being on this end. Like when I get the first call from one of the brokers to talk to me to sell the deal, like man, they're pushy. Like
Oh yeah.
and that was like, I mean, that's a broker, so it's a little bit different, but they're like hyping it up. Everything feels amazing. And then again, I think we ended up doing it and got to the lawyers looking in the back end and there was a bunch of other shit.
Yeah.
So it's like, okay, now I see why you're here. But anyways, I guess my thing is just if you're looking at getting into this game, like you want to be experienced, you probably want to work somewhere. Yeah. And just take your time and underwrite the living lights out of it. And don't be afraid to say no. I would say no more than I'd say yes because a lot of the deals are a little nerve wracking.
Yeah, and that's a great kind of way to leave it too. Is it don't be afraid to say no. And
Yeah.
I think that's the trouble that some get into early on, where they're
exciting,
so
like, boom,
excited
boom,
they get
boom,
a deal coming in. Okay, what do you need? What do you need? Let's fund it. I'm not going to look at anything, right? So, that's a really good point.
Yeah, 100%.
So if anybody is interested in learning more, please do reach out. We're happy to sit down and do a quick, maybe a half an hour call just to walk through the process further, what it would look like for you individually. Obviously, there's different licensing requirements depending on how big you want to go and what area of the country you're in, but we're more than happy to do that. Anything else,
100%.
Neal?
No, that's it.
Thanks, everybody. Yes, sir.
Thanks, guys.
Hey guys, it's Neal Andrino, your co-host and your co-founder at Keystone Capital and Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
And your co-host here, Ryan McNeil. I'm the co-founder and president of Keystone Capital Group. Keystone Capital Group is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000549, and through FCMB, license number 88799. And keep in mind, the views of this podcast are for informational purposes only and is not financial advice.